This video is about stock gains. Look at this stock card. At the end of July, the 31st of July, the stock card says there's a balance of 45 units on hand, $500 a unit, $25,500 in total. Every now and again, management goes and checks the accuracy of the stock card by doing a physical stock take. They walk into the storeroom or the warehouse and they physically count the stock. In this case, they have recorded in this memo number 29, the physical stock take comes back with 50 units on hand. 50 units on hand. This is assumed to be more accurate than the values in the stock card. The physical stock take overrides the stock card. So in this case, there's been a stock gain of 5 units. 5 more units are on hand than the stock card says there is. So what do we got to do? We have to record the stock gain. In the stock card, we write memo 29, and in the in column, because we've gained 5 units, 500, 2500, and the balance ends up at 25,000 or 50 units, of course, and that is what the physical stock take says is on hand. So you always finish with what the stock take says because that is deemed to be the most accurate figure. So we record the stock gain in the memo. We record the stock gain in the stock card in the in column, and we update the balance. And we also record it in the general journal. So in the general journal, you just put the date, stock gain, 5 units, memo 29, and the value. So that's how you record the stock gain. How do you report it? In the reports, it does not appear in the cash flow statement. It is a non-cash transaction. No cash has come in, no cash has gone out, so it does not go into the cash flow statement. However, stock gain is classified as a revenue item, so it does go into the income statement. Let's have a look. You get to gross profit as per normal, in this case 21,000, and if there's a stock gain, you go add stock gain to come up with an adjusted gross profit figure, which will be, of course, higher by the value of the stock gain. So in the income statement, gross profit, then you go add stock gain, and then you get this thing called adjusted gross profit, and then you proceed as per normal. It is possible to have a stock gain and a stock loss in the same reporting period, because most businesses, of course, have multiple stock lines, so they might have a gain in one stock line and a loss in another stock line. So in some exercises, it could be less stock loss, add stock gain, or add stock gain, less stock loss. Usually only one item, but sometimes there can be both a stock loss and a stock gain. And of course, in the balance sheet, this stock control figure in the balance sheet, this 25,000, that is the figure as per the physical stock take. It is deemed to be the most accurate figure. It overrides what the stock card said, so the stock control value in the balance sheet matches the physical stock take. And if we consider the impact on the accounting equation of a stock gain, it would increase assets, of course. Stock's gone up by the value of the stock gain, $2,500 in this particular case. No impact on liabilities. And because stock gain is classified as a revenue, it increases owner's equity, because we know that revenue increases owner's equity. So that maintains the balance in the accounting equation. $2,500 increase in assets, $2,500 increase in owner's equity.